Hey everybody, Marty Missouri here. It's the evening of the 28th of January, 2026. Want to speak briefly to you, just a few minutes on gold and silver. It's been on my mind a lot lately. It's been in the news a lot lately. It's been on a lot of people's minds a lot lately because of just the parabolic moves in both, and silver in particular. So today I'm going to leverage the commentary of a couple of research sources of ours and spend a few minutes just updating the charts with you. So I'm going to pull over our notes and I'll just go to the top and start with gold. So Peter Bookvar, I said here, is saying out loud what I presume lots of people are thinking. He says, the world is changing big time in front of our eyes. The direction of trade flows is morphing and diversifying, and investors need to have a global lens when investing in the coming 5 to 10 years, as it's not going to be just about the US, the S&P 500, or those big tech stocks. At the same time, gold is now becoming the most important reserve currency. So clients, talked about this in most of our meetings, I know I've talked about it here on the blog. A big reason or a big engine or a big part of the momentum in gold has been central banks buying loads of it. China, India, etc. It started, I think, big after the U.S. froze Russia's dollar reserves and the world started thinking about the safety or the sovereignty, I guess, of owning U.S. dollar-denominated assets, if indeed the printer of the world reserve currency can decide to freeze your, again, dollar-denominated reserves. So it made sense for certain global central banks, if not most, to go ahead and start using gold, the one currency, of course, been around for centuries, that is good in all currencies. And it hasn't led up to any great degree. It's not that they've just bought relentlessly nonstop. Of course, they've paused, but I don't think central banks have let any of that go. And from what I'm gathering, the percent of treasuries, for example, that are being held as foreign reserves, where they're typically held in mass, are still there en masse, but not to the extent that they were. So is that a threat to the dollar as the global reserve currency? Unequivocally, no. But are there signs that the world would like to diversify more away from the dollar? Certainly there are. As, for example, Peter Bookvar says in the second paragraph, the announced deal today between the EU and India, where tariffs will fall dramatically. More trade between the two regions will take place in euros and rupees, and gold will be the settling currency with any surplus. And to what I'm saying right here, at the end of 2024, gold made up about 19% of global official reserves, and ended 2025 at 30%. That's quite the leap. He says here in his last paragraph that gold is not a safety trade. It is reflecting a tectonic shift in where global participants are most comfortable parking their money in preserving value, also in terms of physically protecting it in light of the continued freeze on half of Russia's central bank reserves, those are the dollar-denominated reserves I just talked about. We remain long gold, but acknowledge that any moment it could be due for a rest after the extraordinary run. So I think the only thing I'd take issue with is that gold is not a safety trade. Our observation of how it's been trading on news is it is indeed a safety trade. When ships were reportedly heading to Iran, gold was rallying pretty hard. And whenever we seem to get a let up in some of that rhetoric, if you will, or reporting, gold has taken somewhat of a breather, and silver at times a notable breather, as has platinum. So I do think that gold is very much viewed as a safety trade, and it does react to geopolitical events and announcements. I think that if indeed during the course of this year the geopolitical environment becomes somewhat tamer, a little more friendly, I think that's going to be a catalyst to see gold potentially see quite the correction, which I am anticipating, by the way. And people will say that indeed it was a more sanguine, safer view of the world that inspired people to take their profits on gold. So we'll see how that plays out. We still own it. We cut it just a little bit heading into the year. We continue to roll our hedge closer to the money as the price moves away from our strike price. It's not very expensive to do that right here. It hasn't been, and we're happy to do it. We do want to own the position. I wrote volumes over the last few years as to why we like gold going forward. We didn't own it since 1999, and then we bought it in December of 2019. That thesis is still very solid. What's troubling is really just my view as a technician looking at what's been happening of late and comparing that to what typically happens to gold when it's had these kinds of runs. And I know there's always a story. It's always different this time. My best guess is we're going to find out that it's not, and that there's a pretty good correction in the not too distant offing. But I've been saying that for a while, and it just keeps melting higher. We'll look at the chart in a second. As for silver, this is from BCA. This is actually a week or two ago, but I remembered it, so I grabbed it and put it in here today. Silver, is it FOMO, fear of missing out, or fundamentals? Our commodity strategists warn that the odds of a major drawdown in silver have risen and caution against chasing it higher. The rally appears to have been driven more by speculative momentum than the fundamentals. Industrial demand is falling short of expectations. Signs of demand destruction are emerging as elevated silver prices prompt adjustments on the consumption side. Our colleagues' indicators show extremely overbought conditions. I'm going to show you that in a second. With technical signals flashing warnings, record high bullish sentiment further raises the risk of a shakeout. So from what I'm reading, in terms of solar panel manufacturing, beginning to use substitutes for silver because it's just getting too expensive. In other industrial uses of silver, again, they're looking for alternatives big time because the price has just gone up incredibly over the last few months. And it does feel kind of meme stockish, if you will. Again, we're long-term bulls on silver. We cut our position in half heading into this year. I think we went up almost 50% or a little more than 50% in the first 3.5 weeks of January. As of yesterday or the day before, we cut the exposure back to target. So we're just kind of taking it off the table a little bit so that when, or if I guess I should say, or when that pullback comes, it's not going to be overly consequential for our core allocation. I would love to buy it back at a cheaper level, but we're not getting it so far. Okay, so on to the charts just real quickly. I said I wouldn't keep you too long. The monthly chart all the way back to when Nixon took us off the gold standard in the early 70s. The monthly movement, that's the orange line in the price. The relative strength index, which is designed to measure oversold and overbought levels, as you can see, has not been this overbought since the mid-70s. And when we got to this place and the correction came, it was 21%, followed by another 21% after it bounced way back up to new all-time records. Peaked here 12/31/1974, saw a 45% decline, and then got back to that peak 4 years later, 1978. And then just continued to ramp up, got overbought, peaked in 1980, declined by 57% before it was done, and didn't get back to that peak until 2007, right? Different dynamics, though. We weren't bullish in here. We weren't owning it. We owned it for a while here in 1999, and I think right in here we caught that blip, which was really a nice blip, but we didn't own it even during the whole year. And then really just kind of left it alone until we got all the way back here to 2019, and we're glad we own it. But the conditions, moving to a populist regime and what that means, and inflation and the debt to GDP really paints a nice picture for gold on a protracted basis for quite some time going forward. The thing is that, as people tend to do, they chase things, and gold is getting chased big time. And we've got these great narratives like central bank buying, so I understand it. But again, notice where we got overbought, 9%, 26%, 42% decline, 17% decline. So yeah, it would be unusual for us not to see a nice firm double-digit decline that we are hedging to mitigate with a put option right here. As for silver, the monthly chart of silver going back to the 70s, incredible, right? We had this big parabolic move in the late 70s, early 1980. It peaked in 1980, and then it fell off by, get ready, 90%. And then we stayed right here at that, that $4 range, and then just shot to the moon here again to $50 per ounce in 2011. And we then corrected to the tune of, when it was all said and done, there's 72%. Ultimately, I'll fix that here. Ultimately, 76%. And then, folks, here we are at the kind of overbought levels we haven't seen since that 90% correction. I do not expect a 90% correction, but I do expect something in the double-digit range, despite the fact that the bulls are saying, if you adjusted for inflation all this time, you'd see this. This is just the kind of move that just never sustains itself. Meaning we're not going to go in that direction. Now, whether or not we burn these levels off sideways or a correction, which we expect, of course, that remains to be seen. So folks, in a nutshell, gold and silver are seeing, I think, a big rotation. I saw an article the other day that said the retail investor, the individual investor, no longer wants to buy tech stocks. They want to buy gold and silver. I'll tell you, it's typically the retail or the individual investor that's the last one in, typically the last one out. But, I think gold, and I made this case among hedge funds and, larger institutional investors, they've been way underweight precious metals, right? So who knows how far this can go. So we could get that retail investor continue to push this thing higher for a while. And I think the president's commentary about the dollar here a day or so ago really helped this as well. Last time I looked in the aftermarket trading, the futures markets, it was continuing to go higher. We're concerned about it. We still own it. We have benefited hugely from it, really from metals across the board. We've had kind of a scary good January. Has not been all about gold and silver. Remember, we cut some of those allocations back. But a lot of it has been international. Uranium, our plays on AI infrastructure spending seem to be working pretty well, but we are not celebrating a thing because we had a really good January and a really good 2025. We have to work, I think, harder than ever to maintain a portfolio that has what we believe is the best risk-reward relationship in this kind of topsy-turvy environment. So you're going to see lots of tactical moves from us as we meander through 2026. Thank you, as always, for watching and listening. I'll talk to you again in a day or three. Bye-bye.